But Saira, just in terms of these record highs, I remember the expiration of the stimulus looming large. Remember how that was going to have an impact on incomes and a big shock, and we're going to see it in the data. And the fact that there is no relief package happening right now with the Senate still on vacation. Are you surprised to see this kind of price action given that backdrop?
I mean, we're definitely not becoming complacent here. We are worried about things like stimulus expiration, the election. The markets are not pricing in a Democratic sweep, which could have implications for higher taxes and more regulations. Yeah, the tech sector trade is becoming more crowded here. So we're becoming more selective, but we're definitely not exiting because you do have that positive backdrop of better economic data, positive data points on vaccine news. So what we're doing is, while you're owning your technology, look for value elsewhere. For example, dividend payers are looking really cheap right now. You can get yield there. And then we're going outside of the U.S., looking at value stocks in Europe and around the world. With a weaker dollar, we think you can find value elsewhere, too. So it's definitely time to consolidate your technology bets and then look to put your money elsewhere where you can find greater values.
But Saira, it's hard to find a really common thread among the economic data that we've seen of late. Yes, durable goods was double what the street had expected, but manufacturing surveys have not been strong. We did see jobless claims tick back above 1 million. So if you had to describe the way the data looks right now and how much confidence it gives you to get in the market, how would you describe it?
We're looking for a slower for longer recovery. So exactly that. We don't see this as being a V-shaped recovery anymore. It's going to be spotty. We could see spikes in the virus that cause slowdowns, which do cause slower mobility data around the nation. So actually, that's a great setup for technology stocks, which is why we're not exiting them. These growth companies that are less levered to the economy do great in an environment like that. Our view is that earnings don't reach pre-COVID levels until 2022. So the market's really, from here, it's going to be tough for them to keep going up, straight up like they've been doing, because once we start focusing on earnings and pricing that in, really the market should be pretty in a trading range and through 2021.